welcome. Thanks to John. It's really an honor and a pleasure to be here. My name is Steve Rosenbush. I'm the deputy editor of CIO Journal. As John explained, I'd like to just say a little bit about what we do. CIO Journal launched in April, and it's a digital edition of WSJ.com, which is geared toward chief information officers and also anyone else with an interest in technology as a business tool. And we're intensely interested in the same things that you're interested in, and really thrilled to be here. I think that there's a tremendous amount of excitement and energy, and the ideas here are really, really fascinating. So thanks. I'm going to ask each of the panelists to introduce themselves, and then we're going to get started. David, we're going to start with you first.
It's the being leftmost and having a last name that starts with A, unfortunately happens all the time. Hi, I'm David Aronoff, and I'm a partner with Flybridge Capital Partners. We have two offices here in New York, and we're founded in Boston. We're an early stage venture capital firm, so 90% of what we invest in is in seed and Series A, and we have a very strong focus. One half of our business is focused on enterprise technology.
Great, thank you so much.
And you have the best enterprise tech VC Twitter handle ever.
Yes, my Twitter handle is @DBA, and my parents are Prussian.
Great, thanks a lot.
I love it. I'm Jeanne Sullivan. Sorry for the voice. I had two choices: bail on John or deliver on the promise. So sorry for this, but my spirit's high. My spirit's high. I love this. I'm a founder here in New York City of a firm called StarVest Partners. We're investing from a $250 million fund that we put together in 2009. We have always been, since 1998, when we raised our first fund, B2B play at the expansion level, which means us 2 to 15 million top line revenue. But we'll look earlier because you have to, or you better. And we'll look later because maybe we'll have a exit in our lifetime, which would be great. And don't you think if all these VCs are flocking to New York, setting up shop, such as my friend David to my left, that they should at least become Yankee fans?
Mets.
Yeah.
Anyway, thank you for this. We are very focused on we'll invest anywhere in the U.S., by the way, and we'll be talking about this tonight, that back in 98, actually back in 90, when I first started investing here as a VC, there were no companies to invest in. And now there's plenty, so hey, isn't that fun? And if you pay attention to some of the tricks, I like to inspire the group always with this. Do you realize just in Q2 alone, $7 billion was invested in 900 deals in Q2 alone, and first-time financings over 1.1 billion. So I always say, if you pay attention, maybe you can learn how to get the wallets out of our pocket.
Thanks so much, Matt.
Hi, I'm Matt Turck. Is it on?
I don't think it is.
Okay.
Yeah, that's. Yeah.
I'm Matt Turck. I'm with Bloomberg Ventures. So we've actually been around for 3 years, but in the first 3 years of our existence, we were essentially an internal incubator for Bloomberg, so much more of a Bloomberg Labs, if you want, than a Bloomberg Ventures. We're just starting now to become an actual venture arm. We're interested in connecting with you guys. We're interested in big data. We're interested in finance. We're interested in enterprise software in general. So looking forward to have interesting conversations with you guys. By way of background, I actually co-founded an enterprise software company here in New York, and we raised money in 2001 and 2002. So if you think it's hard to raise money for an enterprise tech company now, you should have seen them. So things are definitely looking up. Again, looking forward to meeting you after this.
Thanks, Raju.
Hi, Raju, Rishi. I have been around the New York tech scene for quite some time, mostly as an entrepreneur. Started two companies here, both in mobile space and one in telecom, actually three companies. One in telecom space over the years. Took money from Sigma Partners, that's based in Boston. They're a 1984 VC firm with over $2 billion in management. And earlier this year, they made a decision, they raised a new fund, and they were going to focus on the New York markets, and that's why I'm here. The claim to fame for Sigma is that we are all operators. We don't hire bankers. We are been entrepreneurs multiple times over. We've all been in operating positions. We tend to focus on 5 value propositions. The first is really the team, because we know that pivots happen, and the team is really the synthesis of everything. The second is really what is the marketplace that you're going after. Enterprise is a big focus of ours, and historically, and will continue to be, although we probably in other spaces as well. The third is really what is your product? Does it have a fundamental need? Is it really sort of disrupting something in the marketplace? The fourth is competition, and what does that look like? And fifth is what your business model is. And we put that as fifth because it's really in that order that I mentioned. We really look at the team first and foremost. As I said, I've been through multiple startups as an entrepreneur, as a CEO, as a founder, and every one of them has pivoted. So, I think that's really a fundamental grounding stone for us. So we're looking forward to being in New York, and I've met many of you, and I'll continue to meet more. Thank you.
Great, thanks, Mark.
Hi, my name is Mark Birch. I guess very background, I'm a commodities trader in base metals. I am a tech investor in companies in the B2B space here in New York City. And I am a aficionado of heavy metal, so if you have any interesting tunes or bands you're listening to, let me know. But I just love New York City. I've been involved in technology as well with some of the bad boys like Siebel and Oracle over the years. And so that pretty much led me to my interest in this area of enterprise and B2B technologies. And all I have to say to David is, go Yankees!
It's going to be a real point of contention. We're going to begin the discussion tonight with a look at the fundraising process, how the fundraising process for enterprise companies differs from the fundraising process for consumer companies. And it's an area that I'm particularly interested in because the consumer valuations have been followed so intensely in the press, but we don't hear as much about the fundraising process for enterprise companies, let alone valuations. So we're going to begin with David, and can you tell us a little bit about the main difference between the process?
I think the processes have become remarkably similar, particularly the advent of cloud computing and really the consumerization of IT. So in our business, we really don't see a difference in the way we evaluate companies that are in the consumer side or the enterprise side. We're looking, I think Raju said, we're looking for great teams, first and foremost. They don't have to be complete. We're looking, it depends on the stage of the company. And so if it's a seed level deal, and that's self-serving because that's a huge focus for us, we're looking for the kernel of a big idea. And, the fact that there are a set of milestones that can be met on a short amount of dollars to really see if that, if that proposition can be met. And that's very similar to the way you think about consumer tech deals. I think there's a question that's always raised that consumer tech deals will require less capital over time than an enterprise tech deals require more capital over time than consumer, and it's not necessarily the case, as we've seen, with some really high-profile companies here in the city raising, ungodly sums of money this week. So I think that's become a bit of an equalizer, and the fact that it's now costs far less. So we reckon it's 1/10 the cost to start an enterprise tech company that it was 5 years ago, 10 years ago.
There are a lot of founders and entrepreneurs in the room. Can you look at this subject from the entrepreneur's point of view? At what point should they think about raising money, and then where do they need to be in their development? How built out must the product be, and how much traction does the product need in the market?
There's a couple of points. If you look at it from a founder standpoint, talking to a VC or an investor early brings with it some risk, or at least some perceived risks. If you talk too early and it's not well baked, are they ever going to talk to you again if it turns out that they ask you to leave their office politely or impolitely? I think the reality is that if you choose the right investor, they're going to want to engage with you as early as possible And in particular, if you're at a seed level, the kernel of an idea and to start having that conversation with an investor early can be really helpful. Helpful to the entrepreneur, because the entrepreneur can then hopefully get some help from that investor, whether it's an angel or a VC or a seed fund, in vetting the idea. And so I think you have to look at the stage of the investment first and decide when it's best to align with an investor. In terms of what you need to bring, I think that there are two sides to it. If you are, two guys and a dog in the basement of NYU, I think the expectation of what you're going to have when you're trying to raise a seed round is pretty little.
It seems that the balance of power is always shifting between the investors and founders. Where are things right now?
It is shifting, and it's hard to say kind of across the board in a real general way. I think that if you are if you're in one of the perceived to be hot sectors and you come with a background, a pedigree, a set of experiences that are that have been incredibly valuable and successful, then the balance has shifted in your favor. It's always been that way, though. I think that we're seeing maybe less of that hot potato in the seed level than we are in the consumer side. But when you look at what's happening in follow-on rounds for hot enterprise companies, here on the East Coast, we see the West Coast VCs coming in and kind of running up the price of deals and putting tons of money in. And I think for us, they're investing on the East Coast. It's actually great because we can take advantage of the fact that they're paying fancy prices for our companies.
Thanks, Jeanne. A question for you. There's a lot of capital available to founders right now. Companies that get funded may have a choice of investors. What should entrepreneurs look for when they strike a deal?
Well, I am sure that the brainiacs that you heard from tonight, both Smartling and Digital Reason, knew the following kind of 4 things that I think are critical. You better make sure that the VC or even angel investor that you're approaching, it has your stage and then your subject matter in mind. You would not believe, even though I telegraph and we telegraph, and it's on everybody's website, what we do and where we focus, the people will call with their biotech platform, even in spite of all communication. So know who you're talking to. Also, I think it's critical that you understand the life of the fund, where they are, because we only have about 5 or 6 years to really make those investments and then in theory harvest them after that. So if you're in the 6th year of somebody's fund and you've got a super early stage deal, unless it's a seed firm like you heard from David, that Flybridge likes, that kernel, great big idea, you're probably not going to get the wallets out of our pocket because, again, we're looking to harvest. So understand that landscape. That's easy, again, to figure out just by doing your homework. And then I do love to share the fact that, oh, God, don't go in cold. You can be sure that those 2 CEOs you heard from today did not go in cold to get those brilliant VCs' wallets out. That they knew who to approach. They got in if they didn't know Howard Morgan or Chris Frelick directly, that they figured out how to get in the first round, that they knew how to find their way in through a warm lead. And guess what? That's what doctors, lawyers, and Indian chiefs on your team are all about. That's what coming to events like this is all about. This creates those warm leads in. I think it's critical to have that, or people just won't pay attention. Unless there's some magic fairy dust that happens for you.
Jeanne, are there any trends that people ought to be aware of when it comes to the way that deals are being structured? I know on the consumer side, on the West Coast, there were all sorts of interesting structures with convertible securities and debt and so forth. Have you seen any of that in the enterprise area?
Certainly. There's a big debate about convertible debt. I like to be in that discussion. It's a very interesting discussion. But we would never, because we're expansion stage, we'd never take our wallet out and do a convertible debt as the first financing. Certainly, we'd play with convertible loans later on and help bridge the company to a financing or an exit. But in the first days, those are mostly left to the super early angels, and not too many VCs play that way. Do you, David? Yeah.
It depends. Well, I think it depends on in a seed round. It really depends what the entrepreneurs want. So for us, we're indifferent in a seed round, but it's very different. It's raising little amount of dollars and not much time with a convert to happen.
Yeah. Now, just this past week, Fred Wilson wrote a blog about convertible debt, and he's very much against it. But it's an often used tool in the tool chest, so you don't have to price something. That's the obvious reason. And yet, so many investors do want to grab that equity because they're afraid of all kinds of things that can go wrong.
Great, thanks a lot. Mark, look back over the last 3 to 5 years. Can you talk a little bit about what trends in technology have speeded up the adoption of new technology by larger enterprises?
Yeah. As we know, IT is not necessarily going to be in many organizations, the most innovative organization on the planet. And usually it's outside influences that are going to make a lot of these things happen, much like SaaS did when Salesforce started to take the market by storm back in the late 99, 2000 period. Yeah, nowadays, I think really one of the largest factors, and I was thinking about this for a while, I think Facebook had an enormous impact in the way that enterprises view technology. It really reoriented a lot of the ways that, I think from three perspectives, really. The first perspective was the fact that people were adopting and using a lot of Web 2.0 technology. And they started to want to see that in the technology in the enterprises. They're getting a lot more savvy about the things that they like, the user experiences that they question, why is this not in the enterprise technology that I'm using day in and day out? Why does CRM not interact this way, or our ERP systems or other types of systems that we're using so clunky? The second thing that happened was, well, because they had so many customers that were leveraging these social networks, it really reoriented enterprises to think about how to access this wealth of information and data and these new channels that were being developed. Before, in the days when I was doing CRM, we had salespeople knocking on doors, we had telephone, the web was kind of a new thing, but that was kind of it. And social just broke open that entire mold. And with that, a lot of data, a lot of different ways of thinking about engagement with customers, plus a lot more data that can be collected, particularly from the marketing and sales perspective. But the third thing I think was kind of really interesting, I think has much more far-reaching implications for enterprise and technology, is this idea of APIs. And companies have been a little bit slow to really think about opening themselves up via APIs, but I think this is actually going to be a much larger trend, much like you've seen Facebook open up the doors and become so huge because of having an open and accessible API. And now you're seeing that with governments, like what New York City has done with open data and many other municipalities. I think we're going to see a lot more companies realize that they can't innovate internally anymore. Their structures don't necessarily enable it. The skills don't enable it. They need people like data scientists, which are hard to collect in these organizations because they want to do other things. And they don't have these types of talents. But opening it up provides a wellspring of innovation that can flow back into these companies. So I think Facebook had an enormous impact. I think that gets overlooked because obviously they're a consumer tech company. But really, I think they've had a massive impact. I think the second one would be Amazon for, I think, obvious reasons. But those are my two candidates.
Which parts of the market in particular are most likely to open up first? Or which parts have started to?
I think what we're seeing is, from an overall perspective, I think people are engaged already with customers in a B2C model. So think about brands. I think that's a classic example of reach out to the customer, having all sorts of customer interactions, being first out there with websites, trying to be engaged in mobile, trying to do really inventive things in terms of engagement across different channels. For example, I've been seeing a lot more interest in building games for brands and be able to use that as a way of getting closer to their customers. So I think brands have actually been a lot more in the forefront of taking a lot of Web 2.0 technology and more far-reaching technologies and trying to incorporate that in intelligent ways.
Good, thanks.
Okay.
Yes, please, jump in.
I think all of this is very true. There's a couple of additional trends that have just accelerated the whole thing. One is the evolution in the way software is distributed, which goes hand in hand. I think David started mentioning consumerization of IT. So this whole concept that you could be selling directly to end users at a grassroots level and build a user base. And once you have built a user base, you can then turn around and sell the actual product to the CIO. But Box.net is in the room. That's a classic example of using that type of thing. So that's one trend, the sort of evolution in the distribution system. The other trend is a massive will be increasingly massive adoption of open source software within the enterprise. So it used to be, apart from Linux, it used to be that open source was used by a small department within a company, and for something non-mission critical. I think what's changing, including at Bloomberg internally, is that we're starting to use core open source software for core, absolutely mission critical, tasks, and we're trying to get rid of any vendor lock-in problem, and we're trying to very aggressively decrease our total cost of ownership through open source, and I think a lot of companies are starting to do that. And what's very interesting is that internally, the developers love open source because it empowers them. So, developers and CIOs used to be essentially selecting vendors and then implementing the vendor software. With open source, you basically re-empower all you guys to actually become leaders in building solutions that will serve the needs of the enterprise.
As long as we're on the subject, that is a really good description of what's driven enterprise spending in adoption over the last few years. What do you folks think will drive enterprise spending and adoption next? What's next on the agenda? Is it going to be more spending on data analytics, more spending on big data, predictive analysis, or something completely different?
I think you have some comments.
Yeah, I do. I've got a couple of comments on it. I mean, I think big data for sure, analytics, but I think it's also mobile. And I think it's something that we've sort of, is a permeating trend. I think mobile is going to now create a whole new genre that we can collect, that we have not been collecting historically. And there are companies out there, Sense Network, Interactive, others that are now taking mobile data and now grinding it to create additional value that's going to overlay on top of maps, on top of location information, on top of everything else that's available. So I think that at the end of the day, you've got to sort of look at it from an enterprise standpoint. How can you leverage that better in your enterprise? But at the same time, we know what the smartphone adoption levels are. That's forcing every single enterprise to say, our consumers now have a new pathway of communication to us as an enterprise. So whether or not we like it, and there were lots and lots of companies 15 years ago, retail establishments that said, I'm going to fight web because, I'm Sears and you come to me because I'm a destination. And, then, fast forward, they're saying, hey, you have to have a website to exist as a retailer. People find out what hours you have, they find out what inventory you have, they find out, whether or not there's comparison shopping. There's all sorts of things that happen as a pre-shopping behavior. Mobile is going to have an impact on an order of magnitude, in-store experiences and whatnot. And then the data collection of that while you're in that retail establishment is going to have a whole game-changing impact. And that's where the analytics is.
I just wanted to go ahead.
Keep going.
Well, my question was, we keep hearing that the real roadblock to implementing some of these technologies in companies, one is a certain amount of skepticism, but when that's overcome, there are a lot of companies that say they just simply don't have the expertise to extract any value from those investments. So how does that problem get addressed?
So, there's smart entrepreneurs solve those problems for the enterprises. I mean, look at what's happening with big data, right? I mean, there's very few corporations out there that have expertise around Hadoop or big data, how to deploy. So services companies are being born. And you got Hortonworks out there that's saying, we're going to handhold the process. We're going to get an infrastructure built around it. I think that has to happen for every industry that needs to deploy. Because absolutely, I mean, large enterprise establishments just do not have expertise. So there's opportunities for people in the room to create services organizations, right? You see, everybody, says, look, the home run is to create a scalable software company. There's lots and lots of great businesses established as services companies that are supporting those new technologies as they come across. And you can all look at those as opportunities to become very big and very profitable, small entities that can grow.
That's good.
Yeah, well, I think that these are symptoms of kind of this dynamic computing architecture that is starting to explode within enterprises. And this is kind of the onslaught from the consumer side where, we think nothing about adding a service here and there every day that are cloud services. And so when you start to think about the penetration of Box or Dropbox, when you think about these things coming onto the enterprise, the fact of the matter is that the walls are evaporating in enterprises. And the IT guys in the enterprises still have full responsibility for what goes on within their organizations, and they have very little authority, or they will have very little authority over time. So I think one of the things that's very interesting to watch is how old themes are becoming new again. When you think about systems management and how you manage systems when some are on-premise and some are in private clouds and some are in public clouds and some are with partners. When you think about security, it was easy to think about a firewall or an intrusion detection system or something like that when everything was in your four walls or your extended four walls. But if you now have a componentized architecture for your organization where things are everywhere and you can't put a static firewall on Amazon Web Services, certainly not easily to kind of do the things that you need to do, all of a sudden the security aspect, when you add mobile to it, the security posture of a corporate enterprise is just going to it's going to be eviscerated. In fact, one of the things that's been quite interesting, Jeanne and I were investors together in a security company 10 years ago. And, and many investors really stopped investing in information security because it became overrun. Way too many companies slicing the salami too thin. And if you fast forward to what's going on right now, we see, led by Wall Street, is just this insatiable appetite for security software and services, because they're still buying the stuff that they bought for the past 15 or 20 years, and they outwardly recognize and acknowledge that stuff just doesn't cut it anymore. And so when I think about why we're here in New York and investing in the enterprise, it's because all these things kind of combine to basically say there's going to be just this massive amount of opportunity for new products as well as the new services.
Matt, just to sort of build on that point, there's so many products and so many new companies, and it's probably cheaper and in some ways easier to raise money and to start a company than it was before. The flip side of that is that there's more competition, and it seems like the stakes have been raised, and that for many startups, 10 million users is the new 1 million users. What are the barriers to entry right now, and what sort of scale do startups need, especially in enterprise?
For enterprise? Yeah, so the 10 million, that's the Chris Dixon quote, right? So the Chris Dixon thing, I think, is very true. I think we sort of coming to the end of an era or end of a cycle on the consumer front. I think it's sort of been in the making for a little while. I think the Facebook IPO, or the issue related to the Facebook IPO, is sort of the one additional nail in the coffin. I think on the flip side of that is that it should, to some extent, open more opportunities for enterprise tech companies to get more of the action, and I certainly think that a lot of the action is going to be in big data and cloud computing over the next few years, which is great news for anybody that's interested in this. Is the bar higher in enterprise tech now? For the next few months, probably not. I think the bar is definitely higher on the consumer side. But one thing that I see here and there, and I don't agree with sort of this idea that it's a zero-sum game, and that if things are not so good on the consumer side, well, at least as an industry, we're going to be fine because things are going to pick up on the enterprise side. And I think that's not quite true. I mean, one, because the consumer tech side of things is, to be honest here, is sort of what is sexy, right? And that's what is driving all the money, all the interest, lots of talent into our industry. It's actually kind of funny, there's all those conversations on like Pendo and TechCrunch and TechCrunch Disrupt around is enterprise software sexy, right? That seems to be like the really important topic. And then you have all the enterprise tech guys explaining why it's sexy. You're not sexy when you have to explain why you're sexy. But what may happen if there's less excitement about consumer tech is that your sort of Wall Street person that's sort of on the fence between starting a company and staying in the hedge fund job, may hesitate because doing sort of, behind the scene enterprise tech stuff is just not as glamorous when he or she has the conversation with their friends. That's one aspect. Second aspect is that as we were starting to discuss, consumer tech and enterprise tech are very intertwined now in a way that just didn't quite happen before. Large internet tech companies have become a source of innovation. So we're talking about big data. Just think about what Facebook contributed to big data, what Yahoo contributed to big data. It's kind of unclear if there's less excitement, less money on the consumer side, how that translates into this kind of like innovation engine that's been happening on the enterprise tech side. And I guess last point is you could argue that it's right or wrong, but a lot of the emerging enterprise tech companies, startups, actually get a lot of other startups as initial customers. So if you're a brand new enterprise tech startup, it's really hard to go to a Bloomberg or a Citibank and say, hey, why don't you become a customer? So what a lot of those companies do is they go to a lot of other startups, typically on the consumer front, and they provide the sort of the back end architecture for that. And the startups are much more open to working with them because they don't have a legacy application. So it's sort of what happened, during the bubble. A lot of the consumer tech companies went down, and for a little while, enterprise tech was okay. But then at some point, the enterprise tech companies had no startups to sell to, and the whole thing kind of collapsed. So, what's happening on the consumer tech is very important for enterprise tech now. And sort of, if Facebook goes down, I think we kind of like all go down
into enterprise. I've got a few more questions about the entrepreneur, what the entrepreneur and the founder needs to know when it comes to raising money. Raju, can you tell us what is overlooked from the investor's point of view? What's the one thing that's usually missing in preparation?
Good. So I have three that are overlooked. So you can go on a website and you can get a great pitch, sort of template. So I'm going to talk about things that I generally see overlooked or have seen overlooked in various pitches that have sort of come my way. And the first is, a lot of people talk about differentiators, and they talk at the feature level. That's not, in our mind as a VC, the true differentiator. I mean, what is the fundamental differentiator of your solution? What's going to get people over the hump to buy you versus the competition? You have to know that as an entrepreneur and a founder. It shouldn't be something that has to be sort of whittled out of a conversation. I mean, that should be sort of front and center. We sort of think of companies in terms of three modes. There are lots of companies that could be features. They're not bona fide investable value propositions as far as we're concerned. The second is their applications, and some are bona fide, investable value propositions, but many are not. And the third are companies. And unless you sort of understand what your fundamental differentiation is, you're going to struggle sometimes in the VC side of things. The second thing that we see is a question that I have to ask an entrepreneur too often in the enterprise space is, where's the money coming from? You have a product, and it's great, but where does the money come from? Is it a replacement from a product that already exists in the enterprise, so they already have a budget, and you're going after that budget? Or do they have to create a new budget for your product? Or you have a built-in ROI, which I have very rarely seen, where you could walk into a company and say, if you plunk down $100,000 for my product, we'll make it back next month. I mean, nobody really believes that. So where the money is coming from is a really important thing to think about when you're going for VC investment. And the third is really at the later stages, not necessarily a pitch that I'm seeing at the very early stages, but what's the fundamental unit analysis of your business? If you have a widget, if you have a product that you're selling, how long does it take to sell one widget? What's the cost of sale? What's the average selling price? What's the implementation cost? What's sort of the support cost for that widget? At a later stage of your business, if you're really coming to us for a late A round or B round of investment, you should really know that because you're ready to scale the business. And if you don't have those sort of information at your fingertips, it may say to the investor that, hey, I'm not ready for the money. And that's the things that sort of we look at.
Yeah.
That's good.
Yeah.
Do you have any other thoughts on that topic?
Yes, something that I actually meant to include too in my first discussion about looking for stage and subject matter is what about just old-fashioned chemistry? If your vibes are putting out this guy's a real or person, woman's a real jerk, and you get that in the intuition. Hey, pay attention, because guess what? You're gonna, sorry to say this, crawl in bed with them for quite a while, and you got to make it good. So I would highly recommend that you have great chemistry, or it actually will be so miserable for both sides. You don't want that scene. So I think that is something to pay attention to. Now, I always love to speak about this as one of my real hot ones. And it's kind of back to what Raju says about features. And there's a marker for the feature-bound CEO. They want to show you a demo in the first 5 seconds, not even, partway through the discussion. I want to know about the business of the business. Like you heard already, the unit economics are critical. Where is the budget? What about the scaling of the business and how's that going to work? But all of a sudden, they're so caught up. Sure, a demo's critical. It's important to understand what you're saying and these features and all, but not in the immediate first opening line. It's an absolute marker. And so pay attention to that.
Do you have any thoughts on the value of incubators for startups? I'm going to open that question to anyone else.
So I think incubators have a purpose. If you're a first-time entrepreneur, there's lots and lots of little things that you probably don't know how to do. And I started 3 companies. I didn't know how to do them when I got to the second company. And there was the payroll, how to set up, W-2s, how to get contracts done. Incubators can help you with mentors. They can help you with a whole host of different aspects of that early stage setup. And most importantly, they can make introductions for you at later stages. So as you get through the incubator process, you get access to a room full of VCs, and there tends to be a little bit of a feeding frenzy at that point. But whether or not you actually it materializes is a different story. But there's value there for people who don't know how to dot the I's or cross the T's, or they're looking for other people to get supplemented to the team. Incubators do a really good job at that. If you're a second or third time entrepreneur, you're probably going to know the pathways a little bit better. And I think verticalized incubators like FinTech, or even ones that exist in pharma world, or ad tech incubators, I don't know if one exists, but if they do, it might be a great place to have it in New York. I think they would add a lot of value because they give you exposure to a set of buyers and a set of decision makers. That's sort of my initial thoughts, but I'm sure others have that.
Tim, you look like you're about to.
Yeah, well, I think that keying up what Raju said, actually, I'm not sure that even just the vertical incubators provide that last thing, which I think is really critical. We've been involved for a few years with Techstars, both in Boston, here in New York, and a few other incubators. And there are, I think, last count, there are 23 incubators in New York City, something like that. So not all incubators are created the same. But I think that what really differentiates them, and the ones that I think companies should gravitate toward, founders should gravitate toward, are ones where the quality of the people that are mentors, which you can see before you start applying to them, that really matters most. And it's more than just a bunch of VCs looking at, kind of like the dog show, trying to see who's going to win the pageant. I think it's more when you look for the customers that are involved, the repeat entrepreneurs that are involved, and to be able to see the success stories that are there. So I think there are some that are, and even when you look at Techstars, which has the moniker of being more consumer focused, you can see the classes in the past couple of years have had a lot of enterprise companies. And it's been really interesting to see that trend start to happen. You can see it in Y Combinator as well.
Which sectors are really hot right now, both from the perspective of the incubator and the entrepreneur, and also on the demand side? What are corporations calling?
I guess I probably should. If I think they're hot, I probably shouldn't say to my other investors on the panel.
That's what you want to know.
Yeah. No. So I mean, there are really three things that that we're looking at, and some of them, I don't know.
Mainframe.
They said AS400 green screen software.
Huge.
Could it be huge?
I'm going to tweet that right now.
No. So I mentioned before, this notion of dynamic computing, and what I really mean by that is this intersection of cloud and open source and published APIs and dynamic scripting languages, really kind of this evisceration of the enterprise. And so as we look at really interesting opportunities there, and for some of the companies that we've seen in the different incubators and startups coming in, they're ones who are playing off that whole notion. And I mentioned systems management before, I think is a really interesting thing in this hybrid model of cloud and private cloud and enterprise. From a security standpoint, that's part of it. I'd say industrial strength mobile platforms are something that we're finding really interesting as well. This notion that we're going to deal with the equivalent of a blue screen of death on your cell phone. Right now, when an app dies on your iPhone and it goes back to the home screen, you don't think twice about it. Yet if that was on your Mac or your PC, you'd be crying bloody murder. And so as the penetration from an enterprise standpoint of these really important mobile applications really takes hold, we're not going to be able to deal with that kind of best effort exercise. There are a lot of really interesting companies thinking about how to really make industrial strength the back end and the support infrastructure around apps. And, I talked about information security, which I think is interesting. I'd say if there's a horizontal aspect of it that I'm really interested in, it's this notion of developer-driven models. And this is really a new way of getting to the enterprise. And it's really kind of getting what the hardest part that we've had investing in enterprise tech over the years has really become affording this really big direct sales force. You've got to have enough cash in the sale in order to afford, several salespeople regionally organized with SEs and a bunch of others. And that model just doesn't work when you're thinking about software that's a lot cheaper. And so there have been a lot of really interesting models, some open source companies and some not, that are focused on distribution through developers who have their own viral network like the consumer side.
Matt, do you have any thoughts on what in particular is hot right now?
What's hot? Yeah, actually, I'll echo what you would say. If you're an investor and you're investing because something is hot, you by definition behind the curve. And if you're an entrepreneur and thinking of your next company, if you're thinking of what's hot, then it doesn't make sense either, right? Because by the time you build it, the trend will pass. But so it's intellectually interesting, but it's a terrible metric or indicator to do anything.
So don't build a company based on anything we're saying tonight. Don't do it.
It's too late.
So the question is, what's hot? Clearly the two big trends, cloud and big data. Within cloud, I think so. Let's see, infrastructure as a service is probably a little played out. Platform as a service is interesting, but getting played out as well. I like network virtualization. I like, so nice here is a clear example of a huge success in network virtualization. I think it's just starting, though. There's lots of things to do. It's very complicated. I like storage virtualization as well as area. So that's sort of cloud. In terms of big data, you probably don't want to build a NoSQL company at this stage.
Please don't.
Because Tangent is doing really well, but also because open source. I mean, we have React and Basho, over there. Cassandra. I mean, it's just sort of becoming very, very. I think innovation at the very fringes of database. It's still some interesting stuff to do. Anyway, it's a tough one. I think there's been going up the stack. I think there's been a bit of a glut of funding of analytics, big data companies at a stage where a lot of large companies that would be customers for those haven't quite caught on with the whole thing. So there's going to be a lot of customer confusion about all these companies, all early stage coming in. So I probably wouldn't do that as well as an entrepreneur. I think it's sort of further up the stack. I think it's going to be very interesting, this whole concept of big data-driven application companies. I think that's just starting. So this concept that, what kind of end-user-facing product can you build that solve, real-life business problems using massive amounts of data? I think that's interesting. And to be clear, analytics, I think is interesting. I think what digital reasoning is doing is great. It's a little late to get into the game right now.
Okay, I'm going to ask a few more questions, then we're going to open up the discussion to everyone in the audience. And this part of the discussion with some thoughts and some comments on the New York VC and VC-backed startup scene. Jeanne, how has it changed? Have you seen a significant increase in the number of enterprise-oriented startups, and what does the community here need to do to keep growing?
So I have been investing here since 1990, and we were talking about this before the discussion tonight. There was nothing, then there was a whole bunch of stuff, then there was nothing again, and guess what? It's back. There's something. I looked up the numbers just for New York, not just enterprise. 137 venture-backed deals were invested in 1995. It's about 4 times that at year-end 2011. So about 400 or so. And that's across the board. But, most of those were business to business, certainly not all. So there is a changing landscape. There's a lot of action here, and isn't that great for all of us? So we love that. And then what can you do if you're playing here? So just like the Finotech startup that New York Seed is doing, you may or may not know that they're about to do an enterprise seed start. And we are just delighted, and we are proud to participate in that as StarVest. Because that gives us an early look. We think that's important and like to play early. So there's more and more and more of what's going on. Lots and lots of groups, like you heard, 23 groups incubating, boot camps, teaching. And again, what happened for me personally and for our firm is that they looked around and said, where are the women VCs? And so we were kind of dragged into what I call the women's conversation and found we loved it. And so we are very involved as a firm.
Is there anything missing in the ecosystem?
Well, as far as what? As what's available?
In terms of, if you compare what's available here to what's available on the West Coast, is there anything missing?
There is. We don't have a whole bunch of successful serial entrepreneurs. It's getting better, but we don't have a whole bunch that we can put up in front of each other. And what the research has shown is that you need that for mentoring and showing the way, modeling. And so that's happening. More and more will happen, but we don't have that. And so you'll see that from groups that are coming. For example, in case you don't know this, in November, the New York Venture Capital Association will be putting on its next Ingenuity Conference, November 7-8, and we'd love to have an outstanding New York-based serial entrepreneur speak, but guess what? It just might be a California-based person, and that's okay. But we need to continue to prosper and have our successful companies spawn this.
The corporate buyers, the customers are here. Why is it that the customers are located here and the vendors are located elsewhere?
No, you're right to say that. The corporate venturing is up. Those numbers are way up. In fact, they were about 20% of all investing that was done last year, so that's a good thing because that will spawn more and more strategic investing, just as you've heard tonight from Matt. And so that's a good thing. And I would challenge you, John. It's hard to get into these companies. If you want to do business, put those companies up here and have them say, if you want to do business with us, here's how you do it. And that's one good way to make those connections.
Great, thanks. We're going to end up with a few very quick questions and very quick answers. I'm going to ask you to answer, if you can, in 1 minute or less. Mark, can you talk a little bit about the role that angels play? That was good. Thank you.
The pressure's off.
Sorry. What role does the angel play in this particular market?
I think there's a huge opportunity for entrepreneurs that are getting involved and starting their companies to work with angel investors. I mean, very few companies I know actually start with institutional investors. So the game in New York City, and it's actually been a very healthy one over quite a long time. Actually, if I had to compare the angel investing community here in New York City compared to something like Boston, which people look to as having a very robust enterprise tech ecosystem, you'd be surprised that there's very few angel investors compared to what we have here in New York City. So I think angel investors are very significant in terms of growing out the enterprise technology ecosystem here in New York City. But actually, to echo something that's been said earlier by Jeanne, when you look at investors, I think it's really critical to look at people who know the domain. There's a lot of people who do tech angel investing. There's a lot of people who are tech savvy, but that does not necessarily mean that they know the ins and outs of financial technology. It doesn't mean that they necessarily know the pharma industry and some of those constraints, or they may have an understanding about the enterprise application space with HR tech. Several years ago, when I tried to launch an HR tech company here in New York City, I pretty much was locked out because there are pretty much no VCs that had, one, an interest in that, or two, really understood the market whatsoever. So I think angel investors are really your mentors early on to help grow your businesses.
This will be the last question for me. David, there were 11 IPOs in Boston last year, and 0 in New York in the last 18 months, in the enterprise space, of course. Why is that the case, and what needs to change in New York?
Well, when you look at those 11 companies, they weren't started in the past 3 years. So first of all, you have to think, when you see the exits that are happening now, particularly in the enterprise side, are companies that are 6 to 10 years old. And so part of it is we just got to wait. There are a number of enterprise tech-focused companies here in the city that are doing great jobs in terms of building robust businesses, earning revenue, growing. It's just going to take them time to be cultivated. So I think that's part of it. You can't just say, here's, plop a bunch of engineers and say tomorrow go public. I think we've seen our fair share of, last year and this year's been a pretty damn good year for acquisitions of early stage companies here in the city. And I think that's a good sign. I think the corollary to Jeanne's comment, it's not just we need great mentors. We're missing successes here. Yeah. There's been $2 billion, multi-billion-dollar liquidity events in enterprise tech kind of companies in the past decade in New York, and they're both double-click.
Do the relationships between the university community here and startups work well, or compared to what you see in the West Coast?
That's something that I think it's a great point. It's emerging really quickly. When you look at what Evan Korth and Chris Wiggins are doing with Hack NY and at NYU and Columbia, when you add, there's 600,000 college students around the metropolitan New York area, and Mayor Bloomberg is building engineers. I think that's going to be one of the lasting hallmarks of his administration. So in the next decade, you're going to have 7,500 engineering graduate students, new engineering graduate students, coming out of New York every year. And it's just remarkable. And that's just with what the administration is doing with the Cornell Technion Institute for Innovation, what's going on with NYU, CMU, and IIT in Brooklyn, and the newly announced stuff that's going on with Columbia. So I think that the collaboration is really starting now. And what Evan and Chris like to say is they're trying to keep good engineers off the street with Hack NY, off Wall Street.
All right, with that, we're going to open up the panel discussion to all of you. So please, yes.
The question is for David. You mentioned alternative sales and alternative software distributions directly through developers. We have actually, incidentally speaking, created a product which makes enterprise databases instantly available to authorized web apps and mobile apps. We have a bit of a hard time getting into the enterprise sector that the product is targeted at. So if I can learn from you about those alternative routes, I'd be very interested in hearing about.
So it's probably a longer answer, but I can tell you is there are two companies in our portfolio that have done a really good job with it. One is 10gen and in the NoSQL database space, and they've just done an excellent job of building momentum and community. And I think that's the big lesson that comes from the consumer side in thinking about this kind of distribution model, is you've got to cultivate and build a very vibrant and kind of passionate community. Another company that I'm on the board of is called Crashlytics, and they've just done it by making an unbelievably pleasurable experience for the developers such that they want to share it, make it brain dead simple, and make it look like a consumer app. So I think those are two maybe nuggets that have been helpful in two cases.
What is the business side, the money-making side of the other side of the equation? Can you distribute the product freely?
Well, one of those has a freemium model, the other is an open source model. Yeah. So freemium model, get them hooked and then charge them once they can't get off anymore. And the other, is 10gen open source model, kind of traditional open source with additional services and products.
Yeah, thank you.
In the back, please.
Hi, my name is Kunal. I have a question for early stage investors. So, it was repeated that you guys want to invest in businesses. So my question is, what assumptions are you willing to sort of tolerate at the earliest stage? Because a startup with limited resources is making a lot of assumptions about several different things. So product, team, customer acquisition costs, channel. What are you most comfortable assuming and betting on, and how early will that go?
Yeah. I think, when I was sort of describing what is missing out of pitches, it really varies. If you're at a very early stage and you've got a small team in place, you don't have the ecosystem and the capital to really answer all the questions that are required. And I think having been an entrepreneur 3 times and seeing sort of events occur every day, you have to sort of look beyond that. You got to paint a good picture, right? So at the earliest stage, I sort of look at companies in 4 stages, and stage 0 is where I start. And stage 0 is when you have an idea and you've got maybe a small team in place and and a market opportunity that exists. If you're a good salesperson as an entrepreneur, you could probably go get some seed capital. And what you're trying to prove in stage 0 is that there's actually some product that you can create which someone is a potential buyer for. You might get a pilot going, you might get a little bit of seed capital at that stage. At stage 1, you're looking you have a customer, you've raised a little bit of angel seed money or even maybe A round depending upon the sophistication of the software. You're looking for a customer and you're looking for to repeat that model maybe 5 or 6 times in the enterprise space. And you're building more of an ecosystem and team. You're trying to gather data that shows some level of repeatability. When you reach stage 2, you're really looking to scale the business, in my mind, right? You're looking for more money that basically answers the question. You've already answered the question of, I've got a product, I know what the price point is, I know what, who the buyer is, I know what budgets it's coming from, I know I have a guess at how long the sales cycle. All those analytics really come in stage 2 when you're looking to scale. So I think the amount of data that you have around the business is going to gradiate based upon what stage you're at. I'm not saying you can't raise money without all of that data. It's just the valuation of your company and who it is that you're going after, whether it's seed or angel versus A round, B round VCs is going to differ. I mean that's my model. Anybody else has an answer to that?
Yeah. Probably as the earliest stage investor up here, I realize that there's a lot of assumptions, right? And there's quite a few of my companies in my own portfolio that have pivoted at least once. And so I think it really depends on what stage, as was very well discussed by Raju. But for me, I want to see if you're going into enterprises or the S&B market space, I want to at least have a pretty good understanding that you know how to attack that space from a business development perspective, because that is missing in every single pitch I see. And you do have to have an idea. I understand it may be a hypothesis. You may not be able to, that may not necessarily scale out. It may not necessarily be the right hypothesis. But I need to see something that tells me that you've really thought through the process a little bit more than just say, oh, we're going to go to Amex Open and they'll distribute our product for us. Okay, that's good, but Amex Open also deals with a lot of pitches, just like investors do at the same time. Again, another example I see a lot is, oh, we're going to hit Chase Manhattan Bank. They're going to be our big customer. We've been in talks. Okay, well, have you plotted it out? What does that look like? Who have you been talking to? Do you understand the sales cycles? So a lot of things can be in play, but at least have some original thought-through process about how you're actually going to try and build this business. And if it doesn't work, okay, we'll get back to stage 1 and figure it out from there. So have something in place.
Just half of a follow-up.
Okay, go ahead.
So in getting into Citibank or Chase, we already talked about how hard it is to get into the enterprise. What's the right first move for someone at zero? Is it to say, I've got a lot of consumer love, or I've got one hard-fought sales contract for one company?
At the seed stage?
At the zero stage.
Zero stage?
Well, I'll just give it to you. But look, putting all your eggs in one basket, that's a really tough proposition. And I think it will depend upon the type of business you're building. I mean, sometimes that has to be your customer because of the type of technology you're building is for that large bank or that large pharmaceutical or whomever. But if it's more of a kind of a general consumerized business tech play, then maybe you don't need to depend on that one customer. You should take a different approach.
Okay, someone from this side of the room? Yes, please.
I just have a question for Matt. Matt mentioned the sort of hybrid of consumer and enterprise, and I think some of the examples that you used were, big ways that Facebook has sort of affected this. But I was wondering if you could give any other examples of sort of where you have, it's sort of like a double funnel. You have, the consumers feeding in on one side, but then a tool that, enterprises are able to access those consumers. If there's anything that's
the company was a consumer business model that then turns around and has a business, an enterprise business model.
Yeah.
Yeah. Actually, an interesting one happening right now is Evernote, which, so as you guys may have seen, they delayed their IPO, which is one of the fallbacks from the whole Facebook fiasco. But that's precisely what they're doing, right? So in order to be able to go public eventually, they need to develop other streams of revenues, and so in the process of leveraging all the very large number of consumers that they have to turn that into an enterprise product. And another classic play as well is if you're a consumer-facing company, but as a sort of byproduct of what you do, you accumulate some very interesting data, very unique data. There's ways you can leverage that as well. And there's companies like Bloomberg, like Reuters, that are interested in that data. So if that can become, for example, an interesting indicator of sort of consumer spending patterns.
Anyone else? Yes, please.
So this for you, Matt, coming from Bloomberg Ventures, which is more of a corporate arm as opposed to standard VC, how would you say you guys differentiate from your more traditional kind of VC company, and then even differentiate that from the new guys like Andreessen Horowitz who are taking more full service approach?
Okay. Well, so this whole debate here, but I think corporate VCs are differentiated by nature because what you bring is the power of whatever organization you have behind you. So we at Bloomberg are not going to be right for everyone. At the same time, for the people that we are right for, we're going to be very, very right, because we have all the expertise, all the software, all the distribution. We have every single financial services company out there. So actually, I think the differentiation is more between VCs than rather between corporate VCs and VCs. Actually, the only people that really don't like corporate VCs tend to be other VCs.
I like you.
When you talk to
there's a lot of love up here in this panel. There's no animosity. That's all here.
But when you talk to a lot of companies that have actually raised corporate VC, they tend to be fine. And corporate VC is so widespread. Salesforce does plenty of corporate VC. It's a great enterprise tech company here, Enterprise, that is almost exclusively funded by VCs, right? By Comcast, by Google, others. So the second part of your question was Andreessen Horowitz. So that's also a long discussion, but I think what they're doing is very disruptive to the entire industry. So the irony of what's going on right now is that the VCs love investing in disrupting businesses, but as we kind of all know, the VC industry itself has been very much disrupted, right, over the last few years. So at the bottom, it's sort of angel list. It's what's starting to happen with crowdfunding, but a little bit higher in the stack. You got firms like Andreessen Horowitz, so specifically Andreessen Horowitz, that showed up out of nowhere, more or less 3 years ago. Now has $2.7 billion under management, and has adopted this full service firm model, which, by the way, they haven't invented at all, but they've been, one, very systematic about it, and two, very, very vocal about it. So the whole, and I'm sure you guys are probably aware of this just by reading TechCrunch and stuff, but so the whole idea, it's modeled after the talent agencies in Hollywood, and so you have 6 general partners, but underneath you have, I think there are about 40 now, professionals, so they have the best recruiter in the Valley, and they have the best business development team in the Valley, so they say. But I think what's very interesting for VC is that this increasing little bit of an Andreessen Horowitz syndrome that's appearing mostly in the Valley, is starting to appear here, where whether you want it or not, you kind of have to define yourself against those guys. So you can absolutely say, well, we sort of do things that way, or we've done what they do for many, many years, but the bottom line is that they've become a de facto reference. So I think it's beautiful and very disruptive.
Yes, please.
So, over under for the next, or maybe even first, $1 billion liquidity event in New York outside of the ad tech industry. You first, David.
What?
Oh, that's your portfolio.
Outside, I can't. Yeah, what's that? You
Not which company. If you want to say which company, you can. But like when, over under on when it's going to happen.
Over. So when? Okay.
What is our
Mid 2013.
Recording.
Long enough away that I can change my mind.
Anyone else?
I think later.
I don't think it's been invented yet. I think we'll see it.
Yeah.
I think we'll see it soon.
no, I think
Is that 2020?
Less than 2020, but
Hasn't been done.
I mean, if public markets don't collapse, and no, I think 2013 could be. I don't know. I assume you're thinking Guild, you're thinking 10 potentially. 10 might be a little early.
I mean, there's a number.
You're an investor, you cannot comment.
I can't comment on any of our companies, but I think you just have to look. So let's assume that the market stays roughly what it is today. When you look at the enterprise companies that have gone public, they're performing much better than their counterparts on the consumer tech side. Even enterprise-related things like LinkedIn have performed better. So I think that, if it stays the same, I think there's some companies that are doing, $100 million of annual revenue this year. Profitable companies. That's the kind of outlook you want to see before taking a company public.
Last question, and we'll take bids for it. In the back, please.
This is a good sum-up question then. Looking forward, what do you guys think is going to be the next big trend in enterprise tech? Whether it's something that's new now or something that's still...
I think something that hasn't been brought up, which I think could be really, really interesting, is the rise of 3D printing and what it means for enterprise technology companies to be able to support a lot of that, again, the consumerization of all this activity and the renaissance of potentially seeing manufacturing in a little bit of a different scale, a little bit different model, but that developing in the U.S. and seeing all the firms that sit around that to support those businesses.
I mean, I'll throw my hat in there. I think the next big near-term trend is mobile security. I mean, I know that there's a lot of players in there. I just don't think there's enough, and we're going to hit a real wall. Enterprises are dealing with BYOD now. A lot of companies are doing, like Enterprise, which is dividing the handset into, sort of corporate and consumer, but the security algorithms underneath that all, who knows? I think that's going to be a problem. I think a lot of companies are going to have to come out of the
Enterprise is really interesting, and they presented here. I thought it was really fascinating.
Yeah.
But there's a lot of open territory there.
Yeah.
Anyone else?
So I'll go. I'll get something that's enterprise class software. Maybe I'm really fascinated by what's going on with the digital living room, and so not so much the end consumer side of it, but what media companies are going to have to do in order to start thinking about their distribution and the control that they have over their media, which is a massive problem that today is pretty much jury-rigged with chewing gum and baling wire. And so I think that there's got to be your mobile screen, your phone, your tablet, your TV, your connected device, whatever the hell Apple and Google are going to do in the living room, can't be second-class citizens to the traditional linear TV. And that's going to be a whole host of problems from enterprise scale software needs to be done.
Okay. We're going to end it right there. Thank you so much. Thank you.
So let's give another round of applause for Steve, our moderator, for our panel, and for our two demos. A couple of last second announcements.